Today, Japan hangs on as inflation rises. Hello again, it's Martin North from Digital Finance Analytics Web. Latest post covering finance and property news with a distinctively Australian flavour. Well, Japan's core consumer inflation rose more than expected to a near 8-year peak in August, according to data released today, as heightened raw commodity costs and a depreciating yen continued to batter the economy with rising price pressures. The National Core Consumer Price Index, which excludes the price of fresh food but includes energy, rose 2.8% in August compared to 2.4% in July, according to data from the Statistics Bureau. The figure also came above estimates for growth of 2.7%. Overall nationwide CPI rose 3% in August, more than July's reading of 2.6%, and also is an 8-year high. The reading marks the 5th straight month that inflation has trended above the Bank of Japan's 2% annual target rate and reflects continued headwinds for the world's third largest economy. The trend comes as industries pass on heightened commodity costs to consumers, and the cost of utilities such as electricity have also shot up this year due to the rising cost of coal and gas imports. The central bank, which will conclude a monetary policy meeting later this week, has given no indication that it plans to move its benchmark rate above the negative 0.1% it currently stands at. But this has severely dented the yen this year, which is trading near 24-year lows against the dollar. Japan's economy is still reeling from the aftermath of the COVID-19 pandemic, with restrictions on travel being relaxed only recently. And the Bank of Japan cited lingering effects from the pandemic as its key reason behind not tightening policy. Rising interest rates across the rest of the globe have made investors less inclined towards holding the yen, which has largely lost its safe haven status this year. In fact, the country logged a record high trade deficit as commodity imports grew more expensive due to a weakening yen, and a softening industrial production meant fewer goods were exported. Despite better than expected growth in the second quarter, the Japanese economy is likely to face continued headwinds from the interest rate differentials and elevated commodity prices for the remainder of the year. In fact, it was announced that Japan will spend 3.48 trillion yen, or $24.31 billion US dollars, in budget reserves to cope with ongoing price hikes and response to COVID-19, the Ministry of Finance also said on Tuesday. The decision was made at a meeting of the Prime Minister's cabinet. Meantime, the Bank of Japan's outlier status looks set to become even more acute this week, with central banks from the Federal Reserve to the Swiss National Bank expected to raise borrowing costs. The Bank of Japan governor and his fellow board members are seen standing pat at the end of that two-day meeting on Thursday, which will come just hours after the Fed unleashes what's likely to be a third straight interest rate hike of 75 basis points. Clinging to the world's only negative policy rate, the BOJ's dovish stance may send the embattled yen sliding even further. Yen slide this year has surpassed the biggest annual drop on record. The governor has said a rapid weakening of the yen is undesirable, but even after the yen hit 144.99 earlier this month, the Bank of Japan continues to hold the view that a weak yen is positive for the economy. Even if the Bank of Japan tried to tweak policy in response to the yen, it would be largely futile, Kuroda has indicated. Massive hikes would be necessary to stop the yen slide, and that would end up breaking the economy in the middle of a pandemic, he said in July. Rate rises to normalise policy can only come with sustainable inflation, and for that Japan needs robust wage growth, he said. Still, the Bank of Japan's stance comes with an increasing cost. While it keeps its short-term interest rates at minus 0.1%, a 0.25% cap it enforces on 10-year government debt is under renewed pressure. A former Bank of Japan executive director said recently that the bank should tweak its yield curve control since the peg is causing the currency to weaken so much. And Bank of Japan officials have already said that raising the yield cap will be equivalent to increasing interest rates, essentially ruling it out as an option until that sustainable inflation is achieved. And meanwhile, Wall Street's main indices ended a very seesaw session higher on Monday as investors turn their attention to this week's policy meeting at the Federal Reserve and how aggressively it's going to raise interest rates. Even more so than the Ukraine war or corporate earnings, the actions of the US central bank are driving market sentiment as traders try to position themselves for a rising interest rate environment. The S&P 500 and the Nasdaq rebounded from logging their worst weekly percentage drops since June on Friday, as markets fully priced in at least a 75 basis point rise in rates at the end of the Fed's meeting on the 20th and 21st, with Fed funds futures showing a 15% chance of a whopping 100 basis point increase, although that's down a bit from the other day. Unexpectedly, hot August inflation data last week also raised bets on increased rate hikes down the road, with the terminal rate for US Fed funds now at 4.46%. This is all about what's going to happen on Wednesday and what comes out of the Fed's hand on Wednesday. So I think people are just going to wait and see until then, said Josh Markman, partner at Bel Air Investment Advisors. We had a Paul print when the CPI came in, so the Fed, who is behind the eight ball, is now trying to get ahead of the curve and curb inflation, and that awareness is driving equity markets. Reflecting the caution for new bets ahead of the Fed meeting, just 9.58 million shares traded on US exchanges on Monday. That's the sixth lightest day of trading volumes this year. And focus will also be on new economic projections due to be published alongside the Fed's policy. Worries of Fed tightening dragged the S&P 500 down 18.2% this year, with a recent dire earnings forecast from delivery firm FedEx, an inverted US Treasury yield curve, and warnings from the World Bank and the IMF about an impending global economic slowdown, all adding to the woes. Goldman Sachs cut its forecast for 2023 US GDP late on Friday as it projects a more aggressive Fed and sees that pushing the job rate higher than it previously expected. The Fed will continue to plough along. We're going to get 75 basis points on Wednesday, but what comes next and whether they're going to pause or not after Wednesday, that is going to be the really interesting part. The Dow Jones Industrial Average rose 0.64% to 31,019. The S&P 500 gained 0.69% to 3,899. And the Nasdaq Composite added 0.76% to 11,535. But of course, the markets will remain fragile until the Fed announcement. And my suspicion is they will remain fragile after. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.